we looked at Minty Cola, and then I told you that we will be looking at another question on audit risk. Correct? I told you guys we'll be looking at another question on audit risk, and then we will be moving forward. Correct? What is the next question that we are talking about? Was it kangaroo constructions? Kangaroo, okay. Kangaroo construction audit risk AA. Okay, were you able to go through the question, guys? Were you able to go through the question? Were you all able to go through the question? Everyone? Did you go through the question?
Oh. Sir,
Yes, boss.
what is the students joining for the workshop? Do you have any idea of what the students?
All the FA students.
Only the FA, only the.
If there are any other students who want to join freely, let them also.
So it's better if I create a link.
Okay. There you go. You have all read the question, right? Okay. Let's go to the question again. The requirement says calculate 5 ratios for both years which would assist the audit senior in planning the audit. Calculate 5 ratios. Okay, you're supposed to calculate 5 ratios. Well, your examiner has not given you what are the ratios that needs to be calculated, so you can decide the 5 ratios that you have to calculate for both years which would assist the audit senior in planning the audit. We know why you have to plan the audit. We already know why audit planning is very crucial. And then the examiner says using the information provided and the ratios calculated. Okay, information provided and then the ratios calculated. Identify and describe 5 audit risks and explain the auditor's response to each audit risk in planning the audit of Kangaroo Construction Co. I told you I'm not going to do this question. I'm going to take you through this question so you can obviously understand how I'm approaching this question. Okay. Now I want you to tell me, have you already calculated the ratios? Did you calculate the ratios? Did you do the calculations? Yes or no? No. Then what did you do? You should have calculated, no? Why haven't you calculated? Okay, come, let's start off. Okay, let's read the question and then we will work on the calculation part of it as well. Okay, before that, part A, 3A says explain the concepts of materiality and performance materiality. Okay, materiality. Something is material if it influences the decision making power. So you need to keep in mind something is material. Figures becomes material in the financial statements. Amounts are material if they influence the decision making power. So materiality means something that will influence the decision making power. For example, let's say um when you take PPIM, you come to audit PPIM. Let's say you come to audit PPIM, and in PPIM, you see in the financial statements, maybe our revenue is about 10 million, for example. If our revenue is about 10 million, what happens? A calculator which is being owned by PPIM is missing. The calculator which is owned by PPIM is missing, and the value of the calculator is about 2000. Is this material? 2000 over 10 million gives you how much? 2000 over 10 million gives you how much? 2000 over 10 million gives you how much? Hello? 0.02. 0.02. Is it material on revenue? Yes or no? Is it material on revenue? Yes or no? No, it's not material. Okay, brilliant. It's not material. Correct. Superb. Now, materiality could be if this was about 200,000. So, materiality is dependent, is based upon values, amounts. Materiality is based upon values, number one. So, an amount is material if they influence decision making power. When it was 0.02%, 0.02, it did not affect your decision making power because it was just 2,000. But the moment it becomes 200,000, from a shareholder's perspective, the value is increasing. Because the value is increasing, they have a bit more caution. So materiality, keep in mind, materiality, amounts are material if they influence the decision making power, number one. So materiality can be based on values. Number two, based on relationship. Now a transaction becomes material due to the nature of the relationship. If the transaction is between director or staffs with the company, then it becomes material. So materiality, when talking about materiality, number one, you'll say it is something is material, amount is material if it influences the decision making power. That is the first point. The second point can be it depends on the nature of the transaction and value. And number three, you can obviously speak about the materiality figures on profits, what is material, threshold, on revenue, on assets. There you go. Are we clear? Are we clear, everyone? Yes or no? Okay. Now let's look at performance material, right? Now guys, there is materiality and there's something called performance materiality. Now when you take auditing as a concept, performance materiality is used to reduce the risk that the total of uncorrected and undetected misstatements exceed the overall materiality. So you have your materiality figure 20,000 or 2,000 or whatever, and below that you keep another figure, a figure lower than your materiality figure. Now while you are doing that, it will help auditors to focus on higher risk areas to ensure that the audit is effective and efficient. Do you understand? Are you clear? So overall materiality is there. Performance materiality is materiality set before another range, set before the original materiality level. So an amount set below original materiality. Are we clear? Are we clear? Some students are struggling to join. So, two things. Materiality. So, can you explain with an example? Okay. Okay. Let's think about a company with an annual revenue. Let's think about a company with an annual revenue of 10 million. Like now, what we spoke about. Auditor thinks materiality. Auditor thinks materiality is 1%. So if it is 1%, how much is materiality? How much is it? What is the materiality then? Auditor is basing materiality on 1% of revenue. So how much will be material? What is the materiality figure? Well done, Shifa. Materiality figure is going to be 100,000. So there can be misstatements, but it only becomes material. Auditor will consider it as material, will bring it as a bigger problem if it touches 100,000. If your uncorrected misstatements touch 100,000, that's the normal. That's how it is normally. But what happens? Auditor, once again, what he does, he sets a performance materiality. Performance materiality at 75% on materiality. If you set 75% on original materiality, it becomes 75,000. Meaning, if you are going to go with this original problem, if you are going to come with this original issue, and if you come up to 95,000, you will consider financial statements are not material and ignore. But by having a performance materiality, the moment you have 75,000 worth of uncorrected misstatements, what will happen is you are going to push yourself to get to that 100,000. Are we clear? Because you will scrutinize it further. You will push yourself further to see if your materiality is touching 100,000. So a materiality is set at the higher level. A performance materiality is set right after materiality, maybe 75%, 80% based on auditor's judgment, where you are trying to get to that 75, 80,000. But let's say you got only to 72,000. That means, okay, this materiality is not hit. No, so you're not going to scrutinize further. You're going to leave like that. But let's say you hit more than 75,000, then you're going to see if it is a real problem or not. Are we clear? Are we clear, everyone? Are we clear, everyone? Yes or no? Everyone. Because most of the students get a bit confused with materiality and performance materiality. Others, everybody, are we clear? Afzal, Inshifa, Keshan, Saifullah. Super. Now, guys, your points to answering the exam would be, okay, first you talk about what is materiality. over here. Number two, you can talk about materiality can be by nature or by value. By value, you can talk about your profits, revenue, total assets. By nature, you can talk about the transaction between directors. And then you can talk about performance materiality. That will give you a 5 marks in the exam. A performance materiality is an amount kept below the materiality figure, so that the moment you hit the performance materiality, you can scrutinize it further. Understood? Super. Kangaroo. Take a minute, read it on your own and give me a done. I get some water for myself. Okay, can you give another example, sir? Okay, you want another example, Saifullah, for materiality by nature, is it? Okay, now do you understand that materiality can be based on value? You understand? Okay. Regardless of monetary value, materiality can be also considered based on nature. Now, consider a company which has a transaction involving a related party. Related party means within a company, a related party can be a director, a shareholder, employees. So, if it's by a board member, even if the transaction is a small transaction, insignificant transaction, still it becomes material because it is done with a related party. Because related party, if you are a board member, that particular person can influence the prices. Are we clear? Okay, brilliant. Okay, read the question quickly. Read the question, give me a done. Once you're done, give me a done. Quickly read. Students already applied for exams. Already applied for exam. Obviously, by now you should have applied, or you wouldn't have applied. Give me an A if you had already applied. Shifa, Saiful applied, Abdullah applied, 3. That's it. Only 3 students have applied. Keshan, Afzal. Applied. Keshan applied. Afzal. Afzal also applied. So everybody has applied. Okay. Let's look at the question, okay? You are the audit senior. Okay. There's a position that is being given for you to play. You are the audit senior. Wait, what is this? Okay, that's highlighting. Okay, you are the audit senior of Rhino and Co. And you are planning the audit of Kangaroo Construction. Planning. We know what this planning is about. We did study last week how planning can help perform the audit. Planning the audit of Kangaroo Construction Co. for the year ended 31st March 2013. Kangaroo specializes in building houses. Kangaroo builds houses and provides a 5-year building warranty to its customers. Okay, superb. Your audit manager has held a planning meeting with the finance director. He has provided you with the following notes of his meeting and financial statement extracts. Okay. Any problems so far? So far, do you have any problems? First paragraph, do you have any problem? First paragraph, any problems? Any issues? First problem, first paragraph. There could be a risk with warranty provisions. There could be a risk with warranty provisions. Okay. Could be. Could be. Okay. Let's go further. Kangaroo has had a difficult year. House prices have fallen, and as a result, revenue has dropped. Revenue has significantly dropped from 15 to 12.5 million. Dropped, correct, right? In order to address this, the management has offered significantly extended credit terms to their customers. However, demand has fallen such that there are still some completed houses in inventory where the selling price may be below cost. During the year, whilst calculating depreciation, the directors extended the useful life of plant and machinery from 3 to 5 years. This reduced the annual depreciation charge. Kangaroo has had a difficult year. House prices have fallen, and as a result, revenue has dropped. In order to address this, management has offered significantly extended credit term to their customers. Any issues there? From this point to this point, do you find any problems? Extended credit terms might overstate receivables. There you go. Saifullah says extended credit terms. You're extending your credit terms to your customers, so that could overstate that could overstate your trade receivables. Now that alone, Saifullah, is not enough. I would probably want you to calculate trade receivable days. Can you quickly calculate trade receivable days for us to understand if that is the case in reality? Trade receivable days, please. Two thousand and 2013 trade receivable days. How much? Guys, I want everybody to give me. I want everyone to give me trade receivable days. I got it from only Saiful has given me. Okay, Inshifa has given me now. Okay, Arif bro is here. Arif bro, you want to be the host? I'm not the host to make you the host. Sorry, mate. Inshifa says 9149. 9149. Correct or incorrect? 9148. Trade receivable days 2013 2012 9148 48 or 49, I think. Guys, please respond, please respond. Please respond. 9148, correct? Receivable days will be trade receivables over revenue into 365. Trade receivables over revenue into 365 days. Abdullah, Afzal. Saifullah, Keshan, Inshifa. Everybody get the answers, please. Everybody get the answers. Okay. So basically, if you look at the trade receivable days, obviously the trade receivable days have gone up from 49 to 91. Are we clear? From 49 to 91. And the first point that we were trying to talk about was, yes, Kangaroo has given extended credit terms to their customers. Yes. So if Kangaroo has given extended credit term to its customers, it is also reflected by the increasing trade receivable days. So obviously there is a risk of bad debts not being accounted. Therefore, trade receivables, and profits can be overstated. That could be correct. Well done, Ishifa. Now, how are you going to verify? How are you going to confirm if this is correct or not? If trade receivables is overstated, guys, obviously you can perform an aged trade receivables analysis, an aged trade receivables analysis, an aged trade receivables report can help you understand if the trade receivables are overstated or not. An aged trade receivables analysis would help you understand if the trade receivables is overstated or not. Are we clear? Are we clear? Understood? Understood? Everyone, respond. Okay. However, demand has fallen such that there are still some completed houses in inventory where the selling price may be below cost. There you go. You got your second point. So there are still some completed houses in inventory where the selling price may be below cost. So what does that mean? So if the selling price is below cost, obviously your inventory valuation is not written down to NRV. Your inventory valuation is wrong. Then your inventory and profits are overstated. So your second point could be your inventory overstated and your profits are overstated. What can you do? What would be your response? Your response could be you will do a detailed cost or NRV testing to understand if NRV is written down. You can also discuss with the finance director why NRV was not written down, or you can look at house sales after the year end to understand if NRV requires to be written down. We have come across this. Guys, as you do few questions in audit risk, you will understand there is a pattern. That pattern follows. Okay. During the year, whilst calculating depreciation, the directors extended the useful life of plant and machinery from 3 to 5 years. This reduced the annual depreciation charge. Do you have a problem there? Do you have a problem here? Do you have a problem here? Do you have a problem there? Can you change the useful life of plant and machinery from 3 to 5 years? Is it permitted? Are you allowed to change? Can you revise your useful life? In Shifa, what do you think? Can you revise your depreciation useful life? Yes or no? Is this revision, extension, revision permitted or not permitted? Is this permitted or not permitted? Is that permitted or not permitted? Is the revision permitted or not permitted? Hello? Because I want you to respond. Is this revision permitted or not permitted? Well, extension, Afzal permitted, Abdullah permitted or not permitted? Keshan? Actually, you can extend. Saifullah, you can actually extend. This extension is permitted, Saifullah, but it has to be genuine. You understand? It has to be genuine. If it's not genuine, then it is not permitted. If it's not genuine, basically what is happening, your PPE is overstated. Are you clear? So you can obviously go back and ask, it's permitted. In terms of permission, there is no problem. Permitted. Okay. So is it permitted? If you ask me, is it permitted to increase the useful life of the assets? If it is genuine, you can. But does it look like it's genuine? Probably no. It doesn't look like it's genuine. So what can you do? You will discuss with the directors. You'll talk to the directors. Tell the directors, say, look, I want to know the reasons. I want to know the reasons as to why the useful life, was extended. I want to know the reasons as to why the useful life was extended. Number one, from 3 to 5 years. And I will also, as an auditor, I will also compare previously the replacement time period of the asset. Previously, how long did it take to replace the asset? So previous replacement period, I will also check that. And then I'll see, okay, previously, okay, maybe for a fan, if they have taken 3 years to replace, right? Now, if they say the useful life is 7 years, I won't buy it. I'd say previously you took only 3 years to replace. Now you're saying 7 years. No, that doesn't work. So I'll make sure that I understand if this is a genuine increase by discussing with the directors as to why they extended the useful life. And number two, I will look at the previous replacement period. Are we clear? Understood? Are we clear? Okay. The directors need to meet a target profit before interest and tax of 0.5 million in order to be paid their annual bonuses. In addition to try and improve profits, Kangaroo changed their main supplier to a cheaper supplier alternative. This has resulted in some customers claiming on their building warranties for extensive repairs. To help with operating cash flows, the directors borrowed 1 million from the bank during the year. This is due for repayment at the end of 2013. Any problems there? Any issues there? The directors need to meet a target profit before interest of 0.5 million. Okay, now you are supposed to meet this to get your annual bonus. If you don't meet it, you will not get your annual bonus. In simple terms, what is happening? You can probably manipulate the financial statements. To achieve this 0.5 million. But can you manipulate in terms of judgments, in terms of estimations? You can manipulate. Are we clear? What would be an appropriate response to this? For this manipulation, what would be an appropriate response to this? Give me a response. What would be a response to this? For this manipulation, what could be a response? What do you think could be a response? Maintain professional skepticism, but just don't give that. Give me a full sentence. Give me an answer. I want an answer. Type an answer for me. for this, type an answer for me. I want everybody out there to type the answer for me. I want everyone to type the answer. Inform the team members to maintain professional skepticism and request the team to give more attention to income statement items. Oh, I will, if I have to put up a nice answer, what I would do is, okay, I'm just giving you a sample, okay? I would rather say something like this, okay? So I will inform the audit team related to the targets. Number one, okay? Target bonus, target bonus, and will request them to be alert in relation to any inappropriate use of judgments and estimations. Further, I will inform the audit team to maintain professional skepticism. Do you understand? That would be a complete answer. Not just say no. I will maintain professional skepticism. I don't want you to just do that. I want you to give complete answers. Are we clear? Are we clear? Why is everyone? Okay, super. Give complete answers, please. Okay. And any other problems? Do you have any other problems? Do you have any other problems? Any other problems? Any other problems? Any other problems? What's the next problem? Before bank loan. Before bank loan. Using cheaper alternatives. Okay, what cheaper alternatives? The directors need to meet a target profit before interest and tax of 0.5 million in order to be paid the annual bonus. In addition to try and improve profits, Kangaroo changed their main material supplier to a cheaper alternative. This has resulted in some customers claiming on their building warranties for extensive repairs. Now, what is happening? Your customers are claiming warranty. Your customers are claiming warranty means your warranty provision should go up or come down. If your customers are claiming warranty means your warranty provision should go up or come down. Go up. Your warranty should go up. So there's a risk that, all the warranties have gone up. Warranties are not properly accounted for. Risk of warranties not accounted. Risk of warranties not accounted, leading to what? What will happen? In this case, what is affected? What are the elements in the financial statements affected? If you have not accounted for warranty provisions properly, what is affected? Give me a response. Revenues and profits overstated. I want a proper response. I want a proper response. Give me a proper response. If warranty provisions are not properly accounted, what is affected? There you go. Inshifa, well done, Inshifa. Others, what are the items affected? Your profits overstated, your liabilities understated, for provisions for warranties understated. Guys, you should be able to answer like that. You should be able to answer like that. Are we clear? I feel you need to work on audit risk even further. Not enough. Okay. Give me a proper response to this. Give me a proper response to this. Okay. Write a sentence for me. Response to warranty provisions. I want a response. I want a response. I'll give you about 2 minutes. Write a response. I have got multiple responses, right? I've got multiple responses, which are okay. But can we do a little shortcut? Can we make it very easy? If I'm you, my argument is that warranty compared to last year should be higher this year or lower this year, H or L. Warranty compared to last year should be higher or lower. Simple. First thing I can do is compare warranty provisions to understand if there is an increase. This will prove that okay, there was an increase. So from last year to this year, it is a bit reasonable to understand. So it's an increase. To confirm reasonable, yes, that is number one. Okay. Number two, you can also obtain further. You can also obtain a written representation letter from the management to confirm that whatever they have done, the calculation is correct. Are we clear? Are we clear? Super. And then directors borrowed 1 million from the bank during the year. This is due for repayment at the end of 2013. Directors borrowed 1 million from the bank. 1 million from the bank. Any problem with that? Do you have any problem with that? $1 million from the bank. Do you have any problems with that? Well done, Saifullah. Saifullah says classification. Correct. Now here classification is a problem. This is due for repayment by next year. This has to be a current liability. So what would be an ideal response? Your ideal response will be, I will review the financial statements to confirm that it has been correctly categorized as a current liability. There you go. There you go. Guys, what do you think? How do you find? How do you feel? How do you feel? So we've looked at 2 audit risk questions. How do you feel now? How do you feel? Audit risk, you're fine? Audit risk, you're fine? Overall audit risk, are you fine? You're feeling confident, comfortable? You're feeling comfortable, confident? Okay. Any particular area that you're not feeling very comfortable? Because within this period, I'll be looking at substantive testing, internal controls, and I'll be also looking at ethics. So my next primary 3 areas will be this way. Okay.